With your income statement, you can identify whether or not your trends of the property are going up or if they are trending downward. You want to be able to see, am I making money on this project or is this a loss? And if it's a loss, what do I need to be doing to fix this loss going forward? If it's a loss, but it's only short term, then your reporting of the financials on a regular basis allows you to see how quickly you're turning the project around, how quickly you're making it profitable. If you don't get around to preparing your financial statements until April 14th of the following year, you can't use them as a management tool. By the time you have the financial reporting done, it's too late to use it as a management tool. That's why it's so crucial. But as you keep it up to date on a monthly basis, you can quickly look at it each month and identify where your trends are. Are you staying stagnant? Are you improving? Or are you declining, and why? And that's why timeliness matters. You can't manage the business from 12 months ago. You have to be managing it in real time as you're going. It helps you identify issues early. The reason why the timeliness of your financials is so important is it supports a proactive decision making rather than a retroactive.
Welcome to Real Estate to Freedom, the podcast that helps you create the active life you've always wanted through passive income investments. Now, here are your hosts, Dr. Nate and Becky Lambert.
Okay, welcome everyone. Welcome. Today, I really want to talk about financials, which is a topic that's near and dear to me because having worked in banking for as long as I did, I can tell you the importance of financial statements. So we're going to talk about mastering financial reporting for real estate investors and the power of timely and quality financial data reporting. I think this is a topic that is significantly undervalued in the real estate market, although truthfully, probably in most business markets. It seemed in my time as a commercial lender, most businesses felt like they completed financial statements so that they could check the box with the bank that the bank wanted them to complete, or in order to file their tax returns on time. But once they checked the box for the bank or submitted their taxes, that's kind of where it ended. And I want to teach all of you the power of using financial statements to manage your business so that you know and you can pretty accurately predict future cash flow needs, future cash flow shortages, so that you can anticipate the needs of your business. They call this a cash flow projection, and it's super, super crucial. I mean, think about it in your personal life or in your business life. If you knew that you were going to be $20,000 short in November of this year, would you want to wait till November to find that out? Or would you rather find it out now so that you've got a few months to prepare for it? That's what this is all about, is it giving you a chance to prepare for what's upcoming in your business so that you can plan accordingly and either apply for loans or find a business partner or all the various different options, sell something you've got somewhere else to have the cash flow, depending on how much of a cash flow shortfall you're going to have. This is all about preparing for your business and knowing how to manage it appropriately so that you are ready for shortfalls that are likely to come. So my plan with this is to help you guys understand the importance of financial reporting, but not just the importance of it, the importance of timely financial reporting. If I have really high quality financial statements, but they're from 2 years ago, that's not super helpful to me right now. 2 years ago, most likely is not reflective of what's happening right now. So the more timely your financial reporting, the better. I know this is complicated and accountants always seem to take a long time, but a lot of times it's because we're not giving the accountants the information they need to be able to do a good job in a timely manner. So I'll teach you what they need. I'll teach you some software that's out there that can help make this a lot easier for you. And we'll walk through why it's so important. My goal today for this podcast is to help you understand timely and quality financial statements. And what exactly does that mean? We want to talk about what is a financial statement, what does it entail, and which portions of the financial statement are crucial for your business management purposes and when. And then we're going to talk about the benefits of reporting for you as an investor, how it can help you with your business. So first of all, the reason why it matters, all of you who are involved in real estate investing know that real estate is a very capital intensive industry. It means that you need a lot of money oftentimes pretty quickly. If you find a really good deal, you've got to have the money for the down payment on the project. If your project, for example, if you have a 100 unit apartment building and you need to change out the HVAC system in the entire building, Sometimes that can be anywhere from $200,000 to $400,000 on the project, depending on whether or not you need duct work done or just the HVA units themselves. It's a very capital intensive industry, and so having these projections available will help you manage the business. The other reason why it's so important is this is one I see a lot in real estate investing. People will tell me, I'm a real estate investor and I've got rental properties. I've got 4 of them. And I'll tell them, that's so great. We'll sit down and we'll dive through the numbers and I'll show them that they're losing money on all 4 of their rental properties. Now, if that's a short-term strategy because you're going to sell the property, either because they're going to remove the buildings that are there and turn it into a commercial building or something like that. If that's a strategic thing and you know it's losing money, but it's okay because you've only got a few months of this before you make a lot more money on the sale of something related to that, like we discussed, that's okay. But if you have these rental properties that you're holding on to that you think you're making money on and you're actually not, you are draining your financial future. Your rate of return is negative on this because you're losing money. So our goal is to help you know how to track your financials. And if you know what's on the financials, you can manage your business accordingly. All of the concepts taught in this podcast are applicable to any form of business, not just real estate. If you own a company that sells plumbing supplies or showers for houses or whatever, any kind of widget, all of these concepts are applicable to you. There are a few sections that will be a little bit less applicable, but that's when we get to like balance sheet and the income statement of the financial statement itself. As real estate investors, we need transparency in order to run our business. If you do not know that your properties are not making money, then you're not managing them properly. That's why the financial reporting matters. And in order to make decisions, you need to make sure your financials are accurate, that they're highly reliable, that you're using rent rolls, all actual expenses to look at the actual cash flow of your property. We're going to talk about what are the key components of a financial statement. When you go to the bank and they say, I need financial statements on the business, this is what they mean. And this is actually what we're going to use to help you manage your business. This is just a very simplified image of a income statement and a balance sheet. I just pulled these off the internet. As you can tell, these are not necessarily specific to a real estate business. I'll walk you through some of the differences on that. But when the bank asks for financial statements, they need both the income statement and the balance sheet. And when you provide both, this will show the bank that you are a sophisticated investor, that you know what you're doing, and that you are using the financial statements to manage the business accordingly. As a lender, that is really, really powerful because it helps them to know that they can rely on your ability to understand what is going on the financials. So I'm gonna go back to screen sharing one more time. Okay, so on an income statement, that's the one on the left that you're going to see. This is the one that's most important in every business, especially in real estate. This is a simplified summary of all of the income that your property is making, all of the expenses that your property has, and therefore your net income number. The reason why this matters is this tells you whether or not you're profitable to a certain extent. There's a few items that are left out, which I'm going to go through in just a minute. But this tells you what's your income, what's your expenses. It does not include on the expenses the debt on the property. So if you have a debt on the property, just because you have a positive number on net income does not necessarily mean your property is making money. This excludes the debt. And the reason why it excludes the debt is because people often will pay more than they are required to pay, which could mess up the financial statement. And also because this is a tool that's used to sell the property. So for example, if I'm going to sell one of my rental properties to Heidi, Heidi's going to use this income statement to determine what's the cash flow of the property and then balance it against any loan that she could potentially get to buy this property from me. Because when I sell the property to Heidi, she doesn't get to just keep my loan. There are a few loans out there that are assumable. They're less common, so I'm not going to go into those. Usually some of the FHA loans are assumable depending on how it's done. If it's a commercial, like Freddie Mac loan, some of them are assumable. But that's less common. Either way, the income statement does not include the debt on the property. Also, because if I own the property free and clear, then it's going to make it look like it's a lot more profitable on the financial statement than if it had a debt on it otherwise. And the reality is if Heidi buys this property from me, she's most likely going to have to put a debt on it either way. So it doesn't really have an impact on her. So you'll see not necessarily looking at the lines too much, but on income, you're going to see, especially on multifamily, I'll give you some examples on that. You're going to see the rental income. You're going to see late fee income, pet rent, all of those other income sources that apartments often charge, which would be media packages like your internet packages, or their cable TV packages. You're going to see late fees, pet fees. You're going to see if there's a gym included, they have to pay a monthly fee to access the gym, anything of that nature. Any income that is paid to the apartment property project, it's going to be on income. Which, by the way, guys, you need to have one of these on each of your properties. If you own 18 rental properties, you don't want one big income statement including all 18, because then I can't tell which property is making money and which one's losing money. Also, because of commingling of funds. If I own 18 houses and I have one bank account that all the income comes into and then all the expenses go out of, if I have a tenant on property number 9 that sues me for some reason, that tenant could potentially access all of my equity in all 18 of my houses. If I keep them in 18 separate checking accounts and I have 18 separate financial statements and I don't mix and mingle the funds, that's called commingling. Super bad idea, guys. Don't do that. You want to have LLCs that own each of those, a separate LLC that owns each of those 18 different houses. And a lot of times you want that LLC to feed up into a holding company, which either you own the holding company or a trust holds the holding company, depending on how much income you have that you need to protect yourself from. But at a minimum, have separate LLC that owns each of the separate houses or projects that you have, and separate financial reporting on each of them so that you can manage each project. I can see all 18 of my houses on any given moment. I can tell you which of my properties is most profitable. I can tell you which one has the most equity in it and would give me the best ratio if I sell it. It's a management strategy. And I can tell you by looking at it, oh, this one's not performing as well as it did last year. What's going on? Dive in quickly, figure out what's going on, and find out whether rents have gone down or expenses have gone up, or maybe I had a vacancy for 2 of the 12 months this year on that house. And so the overall project isn't showing as profitable, but it's actually making just as much in rents now as it was before. So I know, okay, from a management perspective, I don't necessarily need to change things. Rents haven't gone down. I don't have a bunch of new expenses because maybe the new tenants are trashing the house. Your operating expenses on the income statement will tell you whether or not you have a whole bunch more expenses this year than you've had in the past. That will give you a chance to look into and figure it out. Is it because of poor tenants? Or is it because of deferred maintenance? I just didn't do a very good job of, setting aside funds to repair the roof or the HVAC or anything like that that goes out. Is it just things that needed to be repaired anyway, and I haven't done it for a while? So that's one of the reasons why it can be used as a management tool. Under operating expenses, this will include all of the expenses you pay on the property during that 12-month period, any software that you use for the projects. Now, if I own 18 houses and I pay a fee per year for a certain software, I'm going to divide that by 18 and only allocate 1/18th to each of the houses because I'm using the same software for all 18 houses. So allocate it accordingly, but make sure you include your expenses. One of the things I see left off most often is the difference between accrual versus cash accounting. And we'll go into depth on that in a little bit. But see, this financial statement is September 1st of 2014 through December 13th of 2015. I don't recommend that because that's a weird timeline. Most likely the company's year end is December 13th. In real estate, for the most part, just keep your year end as December 31st. It'll just make your job simpler. The only reason you want to change that is if you were selling a widget item and you have an off-peak seasonality of it. So in real estate, that doesn't really happen here, so don't worry about it. But under operating expenses, you need to include insurance on your property, and you need to make sure you're including property taxes. If you only have property taxes to one entity, then include that. If you have 5 different taxing entities, then you need to include all of those. If your financial statement is only for 9 months of this year, so for example, if it were January 1st through September 31st, which obviously hasn't happened yet, but September 31st of this year, well, what if you don't pay property taxes until November? Should I put them on my financial statement? The answer is yes. You need to be including on your operating expenses 9/12 of whatever your property taxes is. Same with insurance. If you pay the insurance once a year, then include 9/12 of the insurance expense for that year, so that you're actually managing it, because you have insurance and taxes expense every month. You may not pay them every month, but you have them. That's called Accrual accounting. It means I know I'm going to have to pay it, so I break it out on a per month basis on throughout the whole year of the financial so that I have an accurate depiction of how my property is performing and I can manage to it. And there is another form called cash basis. I'll go into it a little bit more in depth in a minute. But I find the accrual basis to be, first of all, more helpful as a manager and more accurate. And quite frankly, your bank will like it a lot better too. When you go in to try to apply for loans, if you're using accrual basis, which sounds like it's a lot more complicated, but I actually think it's so much easier. If you show them accrual basis financials, their level of trust in your ability to manage the project goes up because they understand that you understand what you're doing. And you can have an accountant who does a lot of this. It's not as complicated as you might seem. The financial statement on the right side of the screen is called a balance sheet. This one you don't have to have completed every month or even every quarter, especially in the real estate world, especially because it doesn't change that much. But it is helpful to have at least once a year so that you can balance out and see where's the cash coming in and where is the cash going out. This is just a list of all your assets that this business has, not everything that you own personally, just this business. So if Becky's Dream Life Rentals LLC has rental income from a 100-unit apartment building, the income statement has all the income and expenses. My balance sheet is going to say as of this date, which by the way, the balance sheet is a snapshot. It's like taking a picture. This is what it is at this very minute. It will likely change within a few hours or days or weeks or months. So banks understand this is just a snippet as of right now. And you want that balance sheet to match the same date that's on the income statement for the once a year that you prepare it. You could do it twice a year if you wanted, but it's not super crucial. For the most part, you're only going to prepare a balance sheet when the bank needs it. But it shows how much cash you have in the bank account, any accounts receivable, which would be money that's owed to you, a tenant that hasn't yet paid rent that's going to be paying rent, which you don't have to necessarily go into depth putting as an account receivable. If you're doing accrual basis accounting, this is more for like a business that sells widgets. So they'll sell 1,000 widgets and the companies they bought them have 30 days to make them payments. So that money for that 30-day window be held as an accounts receivable. It'll show any assets you have, the short term, the current assets are anything that's used within the next 12 months. So your cash, any assets you've got short term. In real estate, we don't typically have a lot. If you had a certificate of deposit, for example, it would be a short term or a current asset. We don't typically have a lot of those. Your fixed assets, this is your property. So what is the property worth? Long-term investments, property, plant, and equipment. Long-term investments is really more for other businesses, not so much in real estate. Your property, plant, and equipment, that's your house or your apartment building or whatever piece of real estate you own, what it's worth. And then less accumulated depreciation is just the amount of depreciation you've written off on your taxes with it so far. If you're not sure what that concept means, guys, don't stress about it. We'll go through depreciation on a future podcast much more in depthly. But I'm not going to go into it today because we'll run out of podcast time before we even finish up this one screen. But depreciation, by the way, as a real estate investor, that is one of your best friends. This is what allows you to write down your taxes and not pay as much in taxes. I don't know about you, but I would much rather put $100,000 into another investment than to pay it in taxes because I can turn that $100,000 into $200,000 if I don't have to pay it to the government in taxes. I'm a huge fan of reducing your tax liability, but doing it legally and honestly. Ultimately, you got to be able to sleep at night, and honesty is super crucial to both Nate and I. Intangible assets, we're not going to go into that. Other assets would be, yeah, you don't really have them in real estate. We'll skip that. Liabilities and owner's equity. This lists your debts. So accounts payable is any debt you need to pay that you haven't paid yet. So if you got a bill for repairing the roof on one of your properties and they gave you 30 days to pay it, but you haven't paid it yet, that would be a short-term accounts payable. You won't typically have a lot of those, but every once in a while you have one or two. Short-term loans would be if you have a loan that's due within 12 months or less. So if you're flipping properties, that would be all the amount of the debt that's due in 12 months or less. If you have a hard money loan that's due in 9 months, that would be included in there. Income taxes, you can skip that. Current portion of long-term debt, that is the principal that is required to be repaid during the next 12 months or during this time period. That means if I have a mortgage of $800,000 on one of my rental properties, I'm not putting out $800,000 on there because I don't have to pay all of it this year. It's only the portion that's due this year. You don't need to know about how to do that. Your accountant, a good accountant, will calculate that for you, but just know it's the amount the amount of the principal only that has to be paid down this year. Under long-term liabilities, that's going to be the rest of your $800,000 mortgage. So if 28,000 of it is due this year over the course of 12 months of payments, then the rest of that $800,000 or your 770, what amount did I give? 800. If it was 28, 770, or oops, sorry, we go back on the screen. Yeah, roughly $780,000 that will be due on long-term debt. And then owner's equity, that's just the amount of equity you have in the house. If I owe 800,000 on it and it's due and it's worth $1 million right now, then I'm going to have about $200,000 as owner's equity. The balance sheet, I don't want you guys to stress about that at all because your accountant will prepare that if you need it. It's not overly complicated for him or her to prepare, and you won't use this much as a management tool. This is mostly just to appease the bank and make them feel super warm and fuzzy that you know what you're doing. Just know that there's two parts to a financial statement. What I really want to focus on is the income statement. This is what tells you whether or not your property is profitable, how much money you're making, what are your expenses. And like we mentioned, the net income doesn't include debt. So you got to be able to take that net income amount that's on the financial statement and then compare it to your debt payments on the property. So in this case, it says the net income is $6,206. Well, if your mortgage payments due, your principal and your interest in that same period is $8,000, then you need to know that your property is negative. It is not making money. But if your mortgage payments are only, say, $3,000, then your net profit is about $3,200 for the year. So that's important for you to know. But now that you know what an income statement is and what a balance sheet is, let's go a little bit more into depth on the importance of financial reporting and why it matters. With your income statement, you can identify whether or not your trends of the property are going up or if they are trending downward. You want to be able to see, am I making money on this project or is this a loss? And if it's a loss, what do I need to be doing to fix this loss going forward? If it's a loss, but it's only short term, then your reporting of the financials on a regular basis allows you to see how quickly you're turning the project around, how quickly you're making it profitable. If you don't get around to preparing your financial statements until April 14th of the following year, you can't use them as a management tool because that time period's already long past. By April 14th, as you know, most taxes are due April 15th. There are some exceptions, business versus personal, but we'll just keep it simple here. By the time you have the financial reporting done, it's too late to use it as a management tool. That's why it's so crucial. Real estate accounting is not that complicated. You're tracking your income, you're tracking your expenses, and then you're identifying how much of a debt payment you have and whether or not it's profitable. But as you keep it up to date on a monthly basis, you can quickly look at it each month and identify where your trends are. Are you staying stagnant? Are you improving? Or are you declining, and why? And that's why timeliness matters. You can't manage the business from 12 months ago. You have to be managing it in real time as you're going. It helps you identify issues early. For example, if someone's missing rent, or as I have seen before, someone dropped their rent by $300 a month and their landlord didn't notice for 6 months until, it was the end of the year and they got to doing their financials and discovered, why is my rent so much lower this year? It's because the tenant dropped the amount they were paying and the landlord didn't pay attention to it or didn't notice. There are some legal recourses to that, but it's pretty difficult because you haven't given them notice of default for the last 6 months. So you're usually best to just have them pay the full amount on the following month and have a conversation with them. See if you can talk them into repaying some of the lost rent. But it would have been so much easier if you had just caught it when it first happened and said, hey, thanks for paying rent. I agree. I appreciate it. Your rent was $200 short. So per the contract, if I don't receive the rest of the money by the 5th of this month, there will be a late fee of $200 applied. Just wanted to give you a heads up. So that's really helpful on managing it. Also, the reason why the timeliness of your financials is so important is it supports a proactive decision making rather than a retroactive. You can be planning for your business. It also helps you to stay informed and stay confident on what you're doing with the property. With financials though, guys, there's a phrase called garbage in, garbage out. What that means is if your financial statements are garbage, you can't use them as a management tool. You're going to have garbage management decisions. It is super important that they're accurate. So you need to be tracking all of the actual expenses on the property, whether that's invoices from contractors or any utilities you're paying. You need to be tracking the taxes, the insurance, all those different expenses so that you can have accurate financial reporting. While you're at it, I just keep a file right on my computer where I move all the invoices, all of the receipts, just stick it all in there so that when I go to do taxes, I can give my accountant the financial statements I've prepared and he can prepare the taxes and get them filed. But if I ever get audited, all of those receipts are in that file. If you get audited, guys, you have to provide copies of every one of those invoices and receipts to the IRS. So save them as soon as you get them so that you have them. If it's a physical printout receipt from like Home Depot or something like that, I actually have a stack of envelopes that just have the name of each of my rental properties on the front. And I write at the top of the receipt 118 East and circle it and bring it home and stick it in that envelope. That's not the most sophisticated manner, but it's the easiest. And since I don't do the work myself, I only have a handful of receipts that go in those per year. So it's not overly onerous. If you're doing all the work yourself, you'll want to probably use a software where you can take a picture of the receipt and then it uploads it to your file so that you have it in the event that you get audited. Because I will tell you, Nate and I got audited this year. And I've always thought I'd be scared to death to be audited. But I can tell you that was a much more enjoyable experience than I ever thought it would be. The IRS auditor came to our house. She gave us about a month's heads up. She came to our house. I provided her all of my financial statements on every one of our businesses. I provided her envelopes with all the receipts, and I sent her or copied her on files with all of the electronic versions of all the receipts. And then I had just, we used a VA that we pay like $2 an hour, who's really quite good. Actually, he's so good. He just put numbers on all of them so that the IRS auditor could quickly pull up and see 1, 2, 3, 4, 5, 6, 7, 8, and it correspond on the financial statement so she could double check every single number she wanted to. And while she was here in our house, she's like, well, you've got a lot in here. I probably won't double check them all. And I laughed. I'm like, no, please double check all of them. They're completely accurate. I'd love to like feel like someone's appreciating this work. She laughed. She's like, I've never seen anyone ask for that before. But within like a week or so, she'd let us know that we'd passed with flying colors because every single receipt was there. So plan as if you're going to get audited so that if you get audited, you don't have to worry about it. Everything's already in the file. It really helps a lot. The quality of your financials is important because trustworthy data drives trust with investors and with lenders. If you want to find partners on this project, if your financial statements are garbage, chances are your management is too, because you're not actually managing it. You have no idea how it's even performing. Lenders feel the same way. If they can't trust your financials as accurate, they're not going to loan you money because you have no idea whether it's profitable. How are they supposed to know if it's profitable? It also helps you to avoid costly errors or surprises later on. Like we mentioned, if there's a $20,000 expense coming due in November, or not even expense, if you are likely to be short $20,000 in November on this business for one reason or the other, it's better to know about it months in advance, not when the bill is due and you don't have the money for it. In most businesses, real estate absolutely included, the number one reason why people go out of business is not because they don't get enough rental, they don't have good enough sales from their business or rental income. It's because they didn't manage it well and they ran out of cash. The phrase cash is king, that's what it means. If you've got the cash to pay the bills, you can stay in business. When you run out of cash, you go out of business. Even if it was a profitable business, if you can't pay that bill, the bank has to repossess the house. I mean, that's kind of a more extreme example, but it's real. The bank has to repossess the house or the apartment building because you couldn't make the payments because you didn't allocate funds accordingly or didn't plan in advance. So it allows you to avoid costly expenses. Poor management reporting, the risks of poor management reporting are first, missed opportunities because you didn't know that you were losing money until you'd already lost a bunch of money. Delays in financing or investor relations. So if you're trying to get a loan from the bank, if your financial reporting is poor, you'll be lucky to get it approved first of all. And if you do get it approved, it's likely going to take them months and months and months to approve it because they have to sift through all the garbage and figure out whether or not this project is actually profitable. And if you have investors on the project, if your financials are poor or they're not timely, a good investor should automatically distrust that. They should be worried about, okay, what's going on? Why is it taking so long to get timely financial reporting? Is there something they're trying to hide? That doesn't always mean that they're trying to hide something, but your job as an investor is to protect yourself And sometimes when it's taking a long time to get financials, sometimes there is something to be concerned about. So be prepared for that, know what that means. One of the other risks of poor financial reporting is the tax and compliance penalties. If you don't file your taxes on time, they attach penalties and fines to that, and they often continue to accrue until you pay it. I'm going to give you some real life examples of financial reporting. When I was a banker, I had a customer come in. He had a large apartment building. It appeared to have a lot of equity in it. So by large, I mean like a $12 million project. This is medium, but it was a $12 million project, but he only owed about 6 million on it. So there's about 6 million worth of equity in this project. On paper, it looks like a great project for us to finance. Well, the problem is his financials were so terrible that we couldn't identify whether or not it was profitable or not. He would provide me rent rolls, which is a list of all the units in the project and the name of the renter and how much they're paying. And then usually includes when their lease expires. Per the rent rolls, I could see that this project was making really good money. It was getting top dollar in rents. But the whole financial statements were terrible. And I kept going back to him and saying, Bob, you got to fix this. His name was not Bob. I just made that up. Bob, you got to fix your financials because as of right now, we have no way of knowing if the project is profitable or not. And he kept saying, yeah, I'm going to do it. I'm just so busy. I'm going to get to it. I'm going to get to it. And in the end, we ended up denying the loan because we couldn't get quality financials. I'm quite certain the property was actually profitable, but there was no way to know that without good financial reporting. And in the end, what ended up happening was the investors that were on the project with him ended up kicking him out of the project because he did such a terrible job with the management because he didn't really know what was going on. He wasn't tracking it. So his investors bought him out, managed the project, fixed the financials, brought it back to me. And at that point, when they brought it back, I was actually able to loan them. By then it was worth about 13 million instead of 12 million. And I was able to loan them about $9.5 million. They'd only paid 10 million to buy it in the first place. So they just got most all their money back out and they put it into other projects. But they ended up kicking out the person whose financial reporting was poor and he wasn't making it an effort to actually fix it. If you're not good at accounting, don't stress about it. You can still be good at real estate without being good at accounting, but bring someone onto your team who's good at accounting. It can be a bookkeeper. Real estate accounting is about as simple as it gets, guys. We don't have a bunch of those accounts payable and accounts receivables. We don't often have a lot of those like short-term deposit problems or quarterly tax payment issues. We don't have a lot of that complicated stuff. Our financial reporting is quite simple. That's why I have a spreadsheet that I'll share with you on the deal room that walks through how to report for your businesses for your rental properties on a simplified manner. You'll still need an accountant to file your taxes and to compute things like bonus depreciation or even straight line depreciation. But the basic accounting is not as complicated as people think. So for best practices for timely reporting, you want to be completing your financial books ideally every month, but at least every quarter. Every quarter is every 3 months. So March 31st, end of March, end of June, end of September, end of December. Every 3 months, making sure your income numbers are finalized and accurate, your expense numbers are finalized and accurate, and then your debt payment, I always put at the bottom of the income statement so I know what my principal and interest payments are on the debt so I can compute a debt coverage ratio, which I'm going to teach you about next week. I'm excited about that, just so I can manage the business accordingly. You can use a variety of accounting software items, and then you want to create a reporting calendar so that you mark on your calendar when you need to get it done. And people think, well, how can I have my financials done in a timely manner by June 31st? There's some expenses that still come in right after. You are correct. A timely manner for having the June 31st financial statement done or the end of June financial statement done is usually 30 to 45 days after quarter end. That's considered timely. From a banking perspective, realistically in real estate, you should be able to close it out in 15 to 20 days. We don't typically have a lot of bills that come a month later. And if you have one of those, you usually know about it. The bigger the project, though, the more leeway you need to give. So if it's like a 500 unit apartment building, you're probably not going to get it 15 days after the quarter end. You're going to need to give them 30 to 45 days, typically 45 days, for any final invoices for the pool cleaning or roofing or things like that to close it out. But within 30 to 45 days of the quarter end, you should be getting financial statements on your projects so that you can manage the project accordingly and know how it is performing. For your year-end financial, that's where they take the whole year worth of income and the whole year worth of expenses. That should usually be 60 to 90 days after year end. In real estate, I can usually have it done within 30, just because I like to be on top of it with my management. And I want to give my accountant plenty of time to prepare taxes. But like I said, for a really big apartment building and a bookkeeper who's managing all of it, 60 to 90 is very, very standard so that you can have that ready. Tools and techs that can help. Guys, there's a lot of different tools out here. This is just a short list of the ones I know of. There's probably a lot more out there. We have new apps coming out every single day. So you can check ChatGPT for additional tools that are out there. If others of you that are on here know about other tech tools that are really helpful, go ahead and put them in the chat. QuickBooks is your pretty standard financial accounting books. It's very easy to use, but just know with QuickBooks, garbage in, garbage out. If you don't know where something should be classified as, because if you put it in the wrong spot, it can have an impact on your financial statements. And you might think, oh, as long as it's on there, it doesn't matter. Well, it does matter because it can make your project look like it's not bankable to the bank when it actually is, just because things are in the wrong spot. Let me give you a real life example. One of the projects Nate and I partnered with a while ago, and we've partnered with a lot of people, so this doesn't really specify anything. The partners gave me copies of financial statements on the property, and it looked, per the financial statements, it looked like our partners were taking out approximately 30% of the income of the project and spending it on their own personal living expenses. It was showing as distributions. There were just distributions all over the place. That's the partners taking money out of the business. And I said, hey, Nate, hold on. This is a big deal. I think our partners are embezzling from us. He's like, what do you mean? I'm like, these are the financials. Look at this big problem. And we looked at it and we got really nervous and we started like scouring all of the evidence we had on whether or not this was accurate. And then finally, I'm like, well, let's just call and talk to the partners. I mean, I run the risk of giving them a heads up that we know what's going on, but let's talk to and find out. It turns out they just had a really terrible bookkeeper who was throwing stuff into QuickBooks wherever she felt like it. And QuickBooks was classifying them as distributions because she was putting them in all these other categories because she didn't know what it was. If your bookkeeper knows less about accounting than you do, you shouldn't be hiring them. I'm all about saving money, but to be a bookkeeper, they need to at least understand the basics of accounting and where these things should be classified. He then went back in and fixed the books, but it took him months to fix what she had been just throwing in wherever over months. He went back in and fixed it, and we could see that not only were they not distributing from the business, they were actually putting their own money in to help build the business on various occasions. The exact opposite. The first seemed like a partnership I would never want to partner with again because they're being dishonest. The second one showed that actually these guys are being very honest and they're very good partners. The only difference is where it was being classified in QuickBooks, and so what the reports classified it as. So be careful on that. But QuickBooks is a really, really good one. If you learn how to use it, it's pretty simple. Appfolio is designed for real estate investors. Buildium is designed for real estate investors. Both of those are really good. They provide good quality financials if you put them in the right spot. But just like QuickBooks, you got to know where it goes. Google Sheets or Microsoft Excel is a good one to use for tracking your expenses. I have a template I can share with you on the deal room on where to put your expenses and your income on all these projects so that it classifies correctly. There's also some benefits to automation. There's a variety of software out there that I haven't used yet, but someday I will, where you just take a picture of the receipt, you tell it what project it is, and it just automatically puts it all in for you. It keeps your job super simple. I've heard great things about stuff of that nature. I just haven't personally used it because, like I mentioned, we have a bookkeeper and an accountant, and then we use contractors to do all the work for us. I'm not the one buying stuff at Home Depot, so I don't have a handful of receipts anymore. Okay, the last few things. Reporting for passive investors. This is if, for example, you partnered on a project with Nate and I or with somebody else. You're putting money into the deal and you're getting money back in distributions, but you're not necessarily managing it on a day-to-day basis. You want to keep this as simple as possible. Your partner should provide you financial summaries and financial reporting, ideally quarterly, but at least once a year at a minimum, but really you should be getting quarterly so you can see the progress. That is a little bit harder on construction projects. I will confess that right up front, because you've got framers and insulation and sheetrock on any given moment moving, coming and going. And so it's a little bit more complicated during a construction project, but especially once it's up and going, you should be getting quarterly financial statements. That's not super hard to provide. You need to be getting K1s. You need to be tracking the key performance indicators or KPIs so that you know how the property is performing. Is it improving or is it declining? If there's something on the financial statement you don't understand, you should be asking your partners questions. What does this mean? Why does it look like if the project's income is going down? Things like that. They should be giving you regular updates, at least monthly. Well, at least quarterly, but some really good ones will do a monthly update on how the project is performing. And then your action plan is the last step here. You want to look at and assess your current reporting process, whether or not it needs improvement, and is it an improvement you can make, or is it an improvement that needs an accountant to come in? I would like you all to look at one or two tools that you want to implement to improve your financial reporting, and then schedule yourself for a reporting routine so that you know that every month on the fourth day of the month or fifth or whatever you want to call that, you're going to take 1 or 2 hours of your time and make sure the financials from last month are updated and completed accurately. And you can outsource this, but make sure you outsource it to somebody that knows what they're doing, not just somebody who says they know what they're doing, because it makes a big difference. I can tell you in Nate and I's business, we've outsourced it to our 15-year-old son, Philip. He's super intelligent. I taught him basics of accounting. I use the template, and I just highlight in yellow all the stuff I want him to look online and look up. So he'll jump online and put in all the utilities numbers, all the rental numbers that came on the project. He'll put in the accrual basis for the taxes and the insurance. And he does a really great job. And it helps Nate and I manage our business rather well. It gives us a chance to pay him, which, by the way, we can pay him and write that off on our taxes. It's very, very legal. It's tax deductible. Now, I can't pay him $200 an hour, nor would I want to, because that would set him up for an unrealistic expectation of what life is going to be like. But you can pay him, but you can't pay him more than what you would pay somebody else to do the going rate for that job, based on their quality of how well they're doing. So that's the caveat. You can write off on your taxes and pay your kids some income, but they got to be being paid standard wages for this particular type of work. But we do pay him for it. He loves it. He does a really great job at it. It helps us a lot, and it's getting him really into real estate. So it's kind of a win-win. I love when being an investor gives us the chance to teach our kids skills that will benefit them throughout life. It's one of the things I love about real estate. The last brief thing I want to talk about is cash basis versus accrual basis, because I promised earlier I would go into that. Accrual is better, in my personal opinion. It means all of your expenses that you're going to have to pay for the year that you know are going to come up, your taxes, your insurance. If you have like a quarterly payment you have to pay to the fire department for something, I know some states have that where you pay quarterly a fee for the fire prevention of the fire department. All of those types of things, you divide it by the period of time in which you're going to benefit from it. So on taxes, if you pay once a year, you divide that number by 12 and you allocate for each month of your expenses. That's accrual basis. It's highly accurate financial reporting. It's a tiny bit more work, but it looks really great to the banks. And on real estate, it's not a ton more work. It's like taxes and insurance are the only ones I really have. I know what my taxes are each year, and I just have a place on my template where I put in the annual amount of taxes, and it divides it by 12 and then allocates it on the financial statement according to the number of months they're on the financial. Super simple, nice little spreadsheet that does that for me. Cash basis is a different form of accounting. Banks don't like it as well, but it's easier. And so people will use it. Most banks will accept cash basis, but they don't love it. Cash basis means I report for the income or the expense when I received or paid the cash. So in accrual basis, all of my rents are due on the first of the month. So on the first of the month, I put in under the accrual basis the income for the rents. If my tenant pays it on the 5th of the month, it's fine because it still counts for the whole month. So I put it right in on the 1st. If they pay a late fee, then I pay the amount of the rent, and then I have a separate line that says late fee. On a cash basis, you don't account for it until the cash is received. So if your tenant pays rent on early, this is where it becomes a problem, someone in real estate. If my tenant pays 5 days early because that's when they got paid, and by the time of their next payday, they'll be late for rent. So if they paid it on the 26th of the month, cash basis would include that income on the last month. So I might have a month where I have income on the 1st and then income on the 27th. So it looks like I had a month with just a bang up month with tons of income. Well, then the next month looks like you have no income because there's no income showing there because it didn't get paid in that month, even though it was to be used for that month. That is one of the main downsides of cash basis accounting is it looks like this. You'll have great months and you'll have low months. And the truth is your tenant just paid on time every month. It's not as complicated as cash basis makes it seem. On cash basis, in November, you'll have a big $2,800 bill for taxes. And that's when you account for it, is in November when you paid the property taxes. If you pay your insurance in April for the whole year, then in April you'll have a really big expense. And then you won't have that expense for the other 11 months of the year. That's one of the reasons I don't advocate for cash basis accounting. It is easier because you just throw it in when you get it, but it's not as accurate. And from a management tool, it makes it look like you have income that's all over the board and expenses that are all over the board. So it's hard to identify, except once a year, whether or not your property is really doing well. At the end of the year, then you have the whole year worth of income, the whole year worth of expenses, and you can allocate and look at it, and it will give you a more accurate picture of what's going on, hypothetically. Unless, of course, in December, your tenant paid January's rent in December, so then your financials for last year might actually show 13 months worth of rent, and your financials for next year might only show 11 months of rent. Another reason why I'm not a big fan of cash basis. But those are the two different forms of counting. If someone asks you, now you're smarter because you know that, and you also know why I advocate for the accrual basis rather than the cash basis. But as long as you're accounting, cash basis accounting is better than no accounting. So account however is easiest for you, but just do your accounting.
Thanks for listening to Real Estate to Freedom with Dr. Nate and Becky Lambert. If you enjoyed the show, please rate and review on Apple Podcasts or wherever you get your podcasts. You can download their free ebooks and workshops by visiting realestatetoFreedom.com.